Hi guys, this is Stuart Cruz here, talking to you about a principally protected product and showing you what a structured note looks like that's principally protected. And so here we have a JP Morgan Balanced Value Dividends 5 index. And so this is the index. There are a variety of these types of indexes available. So if I were to show you the list that were available last month, here's a list of structured products with all sorts of different kinds of payout ratios and structures. Here in the principally protected notes, you see this value dividends here. You have a Mojave and Efficient Plus CD and All American and Meridian. So let's just talk about, they all basically work the same way. And here's how they work. You have an index represented by the green line, and your returns on this product, your participation rate to the upside, are 100% to 115% of the upside. So at minimum, you get 100% of the upside, and at most, you might get 115. So what that means is if this index is up 50%, then you're going to get at least 50%. Let's see if I can highlight that for you. You're going to get at least 50% to the upside. So that means you're going to get on a $1,000 CD, you're going to get $1,500 back. Now, if you end up getting 115%, maybe that number is a little bit higher. It's 1,552 and a half. Okay, so but at minimum you participate 100% to the upside. But here's where the principal protection kicks in. So if the green line is down, so at a index return of 0, you get all the upside. 30%, you get 30% upside. 40%, 40% upside. But if it's negative, down 10%, you get your money back. Down 30%, you get your money back. So if you come down here, if you're down 30%, doesn't really matter how much you're down. You end up getting your money back. So you get no return, but you don't lose 30% or 80. You get your money back and live to fight another day. Now you might ask, how is this possible? And why don't people do this more often? Well, let me show you how it's possible first. So I wrote a little ebook on it, structured notes, and let's pull this up here. And basically, a structured product is, principally protected structured product is created by two components: a zero coupon bond and a, hope I don't move that, zero coupon bond and a call option. So I know you might think call options are a little bit risky, but they don't have to be risky. A call option, when you buy an option, you can only lose the amount of money that you put at risk. So if I spend $100 to buy an option, I can only lose $100. If I were to sell an option, then I can often lose unlimited amount. But if I'm buying something, I can only lose the amount that I use to buy. So if we're going to construct this principal protected note, let's say we buy $1,000, we're going to use first a zero coupon bond or a discount bond. And what that discount bond is, or a zero coupon bond is you don't get any interest along the way, but it matures at a particular amount. And in this case, this example, let's say we buy a $900 zero coupon bond, maybe it's $950, but let's just round numbers, $900 zero coupon bond, and it will mature at $1,000. So you're using $1,000, and this bond itself will be worth $1,000 at the end of maturity. That's where you get your principal protection. So no matter what happens to the call option, you get your $1,000 back. So let's look at this purchase. We buy $1,000 worth of this principally protected note. 900 of it, let's say, goes to the bond, zero coupon bond that will mature at 1,000. So we'll get $1,000 for sure. The call option, we might spend $100, and we don't know what's going to happen to that call option. If the market goes up, we're going to get a nice return. If the market goes down, that call option will go to 0. So let's see how this works out. Payout if the index is negative. Well, like I said, the bond went from 900 to 1,000, so you get your $1,000, but your call option is worthless. So your total is $1,000. That's your principal protection. On the other hand, the other option is maybe the index is up. You still get your $1,000 for the bond, and in this example, if you recall, the index was leveraged between 100 and 115%. I used 105% as an example. So your call option, if the index was up 50%, would be worth $525. as opposed to had you invested in the index directly and you would have been worth just $500, this total amount would get you $1,525 as opposed to the $1,500 had you invested directly in the index. So if the market's down, you get your money back. If the market's up, you get even more of your money. And I put up here in this ebook a little bit, imagine this compounding effect. And Einstein said, compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Okay, so that's basically how principal protection structured notes work. This principal protection is not guaranteed over the entire period. It's only guaranteed at maturity. So is there a possibility that if you bought this at $1,000, is there at some point where this principal protection note could be worth less than $1,000? Yes. But think about it this way. If the market were to drop drastically, let's say 30%, this bond might only be down 2 or 3%. If it's only down 2 or 3% and the rest of the market's down 30, well, you dramatically protected your income. And really what you might be able to do then is sell this note, even if you sell it at a small loss, and then buy a new one so that your principal protection, you have a new floor at the bottom. Because if you hold on to this old note, even though you're getting it principally protected, the index would have to rally another, well, if it was down 30%, it would have to rally, call it 40+% in order for you to just break even. And if you do believe in the long-term efficiencies of the stock market and that it will come back, if you sacrifice a couple percent to the bottom so that you can buy in at a far, far lower base and then allow it to build from there, that's another strategy to win. So here's how you can really leverage principally protected notes to your upside. Because when it really dramatically falls, and even though it's not principally protected in the interim, you can really take advantage of the low volatility of this note to augment your returns later. Okay, so I'm Stuart Cruz with Cruz Asset Management signing off on principally protected notes. If you have any questions, please reach out to us at info@cruzassetmanagement.com, or you can email me directly at stuart@cruzassetmanagement.com. That's KRUSE assetmanagement.com. Or check us out on the website, or feel free to look me up on LinkedIn, Cruz AM, or my YouTube page, which is Cruz AM as well. Okay, thanks so much.